Good afternoon, ladies and gentlemen, and welcome to the SYS Group Interim Results Investor Presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Just simply type in your question in the box below and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and publish responses where it is appropriate to do so. These will be available via your Investor Meet Company dashboard. Before we begin, we would like to submit the following poll. I'd like to remind you that this presentation is also being recorded. I'd now like to hand over to Adam Binks, CEO, and Martin Ordsson, CFO of SYS Group. Good morning to you.
Thanks, Mark. Good morning, everybody, and thank you for joining SYS Group PLC's first Investor Meet Company live webcast. Today, my intention is to take you through a history of the business, introduce you to SYS Group PLC, and then also provide an update on our trading for the period 1st of April to 30th of September, which is H1 of our FY21 year. So just to introduce myself and Martin, obviously my name's Adam Binks. I'm the Chief Executive Officer of SYS Group. I joined the company back in 2014 as the Chief Operating Officer and latterly took over in 2018 as Chief Executive. I've got a 20-year career in the technology and telecoms and hosting sector. As I say, been with the business for the last 6.5 years through a fantastic journey of growth. And Martin Ordsson, who is our CFO, joined us in July 2018 as Chief Financial Officer. We brought Martin on from NCC Group, where he was Associate Finance Director. With a great background in M&A experience, given the fact that SYS Group is a buy and build company. Just to introduce you to the wider leadership team within the business. So on the PLC board, we have a gentleman called Michael Edelson, who's got fantastic experience in the PLC sector, been responsible for a number of AIM flotations. Michael was the chairman and responsible for the flotation of Host Europe Group, where he was chairman before he joined as chairman of SYS Group PLC, which has gone on to be a fantastic, huge hosting company across Europe. We've also got Mark Quartermain on our board of directors as a non-executive. Mark joined us back in late 2017. He was formerly chief executive of AIM-listed alternative networks, which he led the disposal of to Daisy Group for 165 million. And we've also got Mike Fletcher, who joined our board early in 2018. Mike's got a great M&A background, former managing director of GCA Altium and founding partner of Pritora Group, which is a boutique investment firm up in Manchester. Mike joins us with a wealth of experience, as I say, in M&A, and a real great addition to our board. Underneath the PLC board, we also have a very strong executive operational board, which consists of the C-suite. So myself and Martin also sit on that board, along with our Chief Sales Officer, CTO, and Chief Marketing Officer. And then underneath that, just to add to the structure, is our senior leadership team, where we have our various department heads that lead the day-to-day operations of the business. So just to give you some background on SYS Group, SYS Group was originally founded as a very different business. It did used to be Daily Internet PLC, which was a mass market web hosting provider that grew to be the 12th largest domain registrar in Europe of .uk domains. And when I joined back in 2014, I joined as part of a new management team that was tasked with using the PLC vehicle to transform the business into a leading managed services provider, which is a journey that we kind of embarked upon in late 2015. So, you know, without boring you to death with the history of everything that we've done, fast forward sort of 5 or 6 years, and we are now SYS Group PLC, having made a number of strategic acquisitions to give us all of the building blocks that we needed to become a leading managed services provider We now find ourselves with a business with a £19 million plus revenue run rate. We reported at FY20 adjusted EBITDA of 2.8 million. We've got 120 team members based across the country. That used to be across 4 offices. Currently, with the COVID situation, it's 120 offices. And we're supporting 700 mid-market customers, again, based across the country, running a 24/7 service team. And one of our key performance indicators that we love to talk to the city about is our solid 97% plus customer satisfaction. So in terms of barriers of entry to this kind of business, there's lots of businesses out there that claim to be leading managed services providers, but what customers really look for when they want to enter into a trusted partnership and a trusted relationship with an MSP is vendor accreditations and partnerships. So you'll see from this slide down in the bottom right-hand corner, our entire group has got some fantastic accreditations there. We're Cyber Essentials, Cyber Essentials Plus, ISO 27001, and probably the one that I'm most proud of is our PCI DSS accreditation. So we are one of a few number of PCI Level 1 merchant service providers certified by the PCI Standards Council to be able to provide services to payment card gateway service providers in Europe, which is fantastic for us, and we do that for a number of customers. So as I say, to bring you up to date now, SYSGROUP is an award-winning managed service provider. We lead with several service lines, being managed IT services and cloud hosting, as well as technical consultancy to businesses in the UK mid-market. So very well placed to help businesses in the mid-market with their digital transformation journeys. And just in terms of historical performance of SYSGROUP over the last 3 years since I've been in the driving seat as chief exec, you'll see from this slide that we've almost doubled revenue in the last couple of years. With adjusted EBITDA and adjusted PBT tracking nicely in a nice upwards trend, and the percentage of adjusted EBITDA to revenue growing nicely without the overhead base growing at a similar rate. So overhead percentage is now starting to come down as a percentage of revenue overall. So we've got a great track record of making acquisitions, integrating them, and then continuing to grow those businesses as we take them forward. So in terms of SYSGROUP's strategy, our overall strategy and where we want to get to, our aspiration is to take this business to become a £100 million market capitalization business. And how are we going to do that? So we're going to continue to execute on our buy and build strategy, which has proved to be very, very successful for us in the last couple of years, and supplement that with organic growth. But we put that message through our business and keep our people on board, primarily through the core values of the business, which you can see across the bottom of the slide deck there. So we've got 5 very, very important values in our business, which we ask our people to operate to on a daily basis. And we want them to love what they do. We want them to be bold and give us ideas and deliver on those ideas, which help transform the marketplace in which we operate in. And we think it's very, very, very important that people within our business own what they do. We want people to own their successes as well as their failures. We don't get it right 100% of the time, but it's very important to own up to mistakes, recognize them, and then we work together as a team in order to rectify those mistakes. But thankfully, we have way more successes than we do failures in this business. And if you put those 3 values together, in turn, that will delight the customer. Everything we do is about the customer. We want to delight customers. We want to hang on to those customers. And we want to see long-term value and long-term relationships come out of those customer relationships. And to achieve that, we need to work smart and together, which again is something that we instill in the business on a daily basis. And we measure all of those things through the KPIs that you can see on the slide in terms of employee satisfaction, our revenue growth and our acquisitive growth, as well as customer satisfaction. So we're regularly communicating with customers, as I mentioned on an earlier slide, to measure customer satisfaction and ensure that we keep that above our target level, which I'm pleased to say it's consistently above 97%. So all of that together puts into our value proposition. Our value prop is all about our people and our services. SYSGROUP is a managed IT services business. It is people intensive. Without people, good quality people who are trained and qualified and experts in their chosen fields, we find it very, very difficult to be able to provide the services that we do to our customers. But all of that together will help us with our vision to become the leading provider of managed IT services and cloud hosting to mid-market businesses in the UK, and will help us drive towards that 100 million market capitalization over the next couple of years. So in terms of SYSGROUP's capabilities, as I've mentioned already, we've made a couple of acquisitions in the last 18 months. So we bought a business called Certus Technology Group in February last year, and we supplemented that acquisition with the acquisition of Hub Network Services later on in 2019, in June 2019. And that has now given us a fantastic data center footprint where we build, develop, and deploy our hyperscale, geo-diverse cloud platforms. And actually, the picture on the right is not a stock image. That is one of the data halls where we occupy some rack space in the next generation data facility in Newport in South Wales, which is one of the largest data centers in Europe. And actually where Microsoft hosts the Azure platform, which I'm sure many of you have heard about. And that gives us a real strategic advantage over other providers of cloud hosting services. Whilst you can connect into Microsoft's platforms from anywhere in the world, we can literally connect in with being in the same building. So it's a cable within the same facility to plug us into Azure and allow that to complement the services for hybrid solutions that we offer to our client base, and really support what we call SYSCloud, which is our hyperscale platform. So we've made some data center consolidation as we've made the acquisitions. The 5 facilities that you can see in the top right-hand corner, being the one in Newport, 2 in London and 2 in Manchester, are the core facilities which we now concentrate on and have become the strategic way forward for us for the build of our hyperscale platform. And that's where we continue to deploy IT workloads for our customers moving forward. And that's all been driven through acquisitive growth. To supplement the data center footprint, one of the most important things that we need is network connectivity. It's great if everybody puts all these fantastic IT workloads into the cloud and into the public cloud and into the trusted hands of managed IT service providers like SYSGROUP, but it all becomes very useless if you can't connect to it. So once we acquired H&S last year, we embarked on an integration project of all the different networks that we were operating. And this slide here is really designed to demonstrate how we can connect in at multiple levels via multiple different tier 1 service providers. And we can take the connectivity for our customers as close to the data center as possible and as close to their offices as practically possible. Without getting too technical, it reduces things like network latency and having to send data up and down the country before it reaches its destination. So our network footprint gives us a fantastic reach out to our target client base there, and gives us the ability to be able to connect them up and have them accessing their IT workloads in our data center environments with relative ease. And then the product portfolio, the service portfolio that's now grown across the group has become extremely vast with the acquisitions that we've made over the last couple of years. So we break them down into 7 core areas, which obviously you can see on the screen there, right from cloud through to disaster recovery and backup and into managed IT, and supplemented by professional services. And in each of those areas, we allow our customers to be able to choose from specific services, or, we really like it when they take all of the services. And some customers even take all of the or most of the services from each of the 7 areas of our portfolio. So this kind of demonstrates that we really are a true end-to-end managed services provider with the ability to deliver and meet the requirements of our customer and our prospect base to deliver world-class managed IT services for them. In terms of SYSGROUP's go-to-market strategy, so you can see over on the left-hand side there, our key verticals where we've got great demonstrated success and where we can show fantastic case studies of what we've done for people in the past. Retail, financial services, insurance, legal and manufacturing. We've got some great case studies and great client wins in those sectors. And our focus is primarily on the UK mid-market. So the biggest opportunity for SYSGROUP exists in the mid-market, where we kind of see a user range from around about 200 users to 650 users. That doesn't mean to say that we're not prepared to play in the enterprise arena. Actually, you know, we quite like to play in the enterprise arena, and we do have a number of enterprise customers that we service and we run some huge platforms for. But the biggest opportunity for SYSGROUP exists within that UK market. That's where our sweet spot really sits. And in terms of the target roles and the focus of when we're prospecting new business, you know, we're looking to deal at C-suite level where we can, where we know that we can really be a strategic advisor and advise the C-suite on how to make a difference to their own business through the use of technology and through a partnership with SYSGROUP to help take them on that digital transformation journey. And then how we access the market, there is a number of channels and routes that we use to access the market and make ourselves known. So obviously we have a marketing function within our business. We have a demand generation function within our business. And we also task our salespeople with generating their own opportunities, both from net new logo and the existing customer base. We also heavily rely on our vendor partnerships because, you know, we've invested heavily in there to become accredited with a number of vendors, including Dell and WatchGuard and Fortinet. And by working together, you know, those vendors typically sell hardware on a one-off basis, but the end customer wants that turning into a recurring revenue solution, which is where SYSGROUP can really support and help turn what would be a one-off sale for a vendor into recurring revenue for our business on typically a 3-year termed contract. And just as a small example of a number of campaigns that we've got out in the market at the moment to demonstrate the currency is we're really capitalizing or trying to capitalize on the COVID situation. And we've got a campaign out right now called Lessons from Lockdown, which is basically a reflection about our own business and some of our customers that have been willing to participate on the struggles that we found at the start of lockdown and how we've used technology to overcome those struggles. There is still a huge opportunity out there to help convert a number of businesses from on-premise IT workloads and bring those into the data center and the public cloud to make their lives easier and help them run their businesses more efficiently through the use of cloud-based technologies. And just to follow on from that, you'll see a number of logos there from some SYSGROUP clients that I'm sure you'll recognize, with the likes of Admiral Insurance and Go Compare, AXA, Sega and Churchill. You know, a great range of customers that we've got in there, providing lots of different services to those guys. So I'm going to come on to the half year now and reflect on the period in lockdown before I shortly hand over to Martin, who will take you through the numbers that we've delivered during H1. But I'll start with revenue. We've delivered revenue 9.01 million in the period. And whilst that's 3% down on the same period last year, where we delivered 9.26 million, I must say I'm extremely pleased with what we have delivered. Back in March, when COVID really hit and lockdown became apparent, I think it was unclear for a number of businesses and a number of people about what was actually going to happen. We couldn't really assess the impact of what would happen throughout the COVID lockdown period. But we moved to home working very, very quickly. We've kept the teams motivated. And as I say, I'm delighted that we've demonstrated the resilience of our business, largely being underpinned by contracted recurring income, and continue to support our customers, and that's reflected in the revenue number that we've reported. And again, similarly with £1.41 million worth of adjusted EBITDA, which has largely come through from acquisition synergy. So, we've got the full 12 months of Certus and H&S in there now. The synergies from those acquisitions have really started to come through for us to produce more EBITDA on slightly lesser revenue. And again, as I've mentioned earlier on in the deck, customer satisfaction, we've managed to maintain our KPI of 97% or above, keeping our customers happy and supported and their services on and connected throughout the lockdown period. We announced, and some of you may have seen back at the full year in June, that we announced a program called Project Fusion within our business. So being a company that's built up of a number of acquisitions, we've managed to accumulate a number of back office systems over the years, and it was time to get that all fused together into a single pane of glass to make visibility for our sales teams and our service teams and executive management to get a better snapshot of the business and really go and identify where the white space exists within our customer base. So I'm delighted to report to the market that phase one of that project is now complete. And phase one was the go live for our CRM system, our service desk system, our project delivery system, and our billing system. So that also means all customers from the acquired businesses are now being communicated with as SYSGROUP rather than the legacy Certus and H&S brands. And again, the integration in lockdown, I'll be honest, something I was very nervous about back in March. I've got a lot of integration experience, as has Martin, but never done it virtually. However, I think we've made a fantastic success with our teams of integrating the Certus and the H&S business into the wider SYSGROUP business on a virtual basis, and actually found it somewhat easier than a normal face-to-face integration with lots of different meetings across the country and trying to coordinate people being in the same place all at once. So, I look forward to subsequent acquisitions where we use Microsoft Teams to integrate those businesses. And again, another key highlight that I need to pull out is whilst COVID has been very, very difficult for a number of businesses across a number of sectors, and with them we sympathise, for our business, it's really demonstrated the relevance and stability of SYSGROUP as a managed IT services provider. Second to the NHS, IT has been what has been required by many businesses to keep the wheels turning. And I'm pleased that SYSGROUP has managed to play its part in that and keep our customers active and trading online to support their own businesses. And the stability coming from our recurring revenue base, which in this period is around about 83% of the number. It really shows the contracted recurring income is so important to businesses in order to help them through what can be a very difficult period, such as a global pandemic, which is COVID-19. So just in terms of our own response and resilience to COVID-19, I know many of you will be interested in how we've reacted to it. So back in March, we were very early to see the lockdown coming, and obviously the rumours coming out of government of a national lockdown. So we decided to invoke our business continuity plan back on the 13th of March, if I remember correctly. And we sent our entire workforce home on the same day. And got them set up for home working, which actually was a relatively seamless process, which we did with ease. And the reason why we did that early ahead of the government's advice was, we're an IT support company. We knew our customers were going to need us. Many of them wouldn't be prepared for home working. They'd be struggling to access systems remotely. So we knew that our workload would increase in that first couple of weeks of lockdown. And we were right about that prediction with a 37% uptick in our normal service desk tickets in week 1 of lockdown. In terms of our exposure to what we call high-risk sectors, being leisure and hospitality, we're not sector focused in any way. Whilst we have target sectors that we like to work in, we have no real sector concentration. So we've got about 6% exposure to leisure and hospitality, which actually throughout this last 7 or 8 months, we've not really suffered any impact from. And we've come to some various support arrangements with those customers in order to help them out. And Martin will give you the detail on that as we move through the finance slides later on. But no real impact or significant risk in terms of sector exposure to our business. We've had no requirement to utilise any of the government's back support schemes. So nobody in our business has been furloughed. We've taken no CBILS loans. We've had no requirement for bounce back loans or any other kind of assistance. The only one thing that we did take advantage of was the deferral of the Q1 VAT payment, which was around about £280,000. Just whilst we saw how the landscape kind of unfolded, we'd have been crazy not to have taken advantage of that. But our intention is to fully repay that money back to HMRC prior to the end of this financial year. So we'll get that paid down before March finishes. In terms of cash, beyond the half year end number, we've continued to generate cash, and we've got a great cash balance sat at 3.5 million today, and we're in an overall net cash position, both on a pre and post IFRS 16 basis. So, solid cash generation from this business. And again, Martin will give you more detail on that as we run through the finance slides. We've continued to pay all of our loan and lease liabilities as normal with no deferrals. So we've not gone into any special arrangements with anybody. Everything is completely BAU, and we've continued to pay those down. So there's nothing inflated in the balance sheet in that respect. And the bank is very, very happy with our position. And as I mentioned already, revenue in the period is underpinned by more than 80%, plus 83% recurring revenue, which just demonstrates the stability of the business, and cash collection on that revenue has been fantastic. Where we did suffer and where the revenue dip came from was in our VAR business, our value-added resale business. So in addition to all the fantastic monthly recurring revenue services that I've told you about in the previous slides, we do have a part of the business that makes up just under 20%, where we do have to resell hardware to our clients. And that's part of being an end-to-end managed IT services provider. The customers want to be able to buy from us the equipment that they need on their desks or the mobile devices that they need in order to access their systems that are hosted in our hyperscale data center platforms. So the discretionary spend on those kinds of things in Q1 of this financial year is where we saw the dip. However, I'm pleased to report that we're now starting to see a recovery in that business line out into H2. I don't think we'll fully catch it up for the full year, but we are starting to see a recovery, which is great news. So Martin, if you don't mind, I shall hand over to you to run through the finance slides.
Yep, thanks, Adam. So we've just got a few slides just to run you through the financials, predominantly obviously for our half year results and balance sheet and cash flow position. I think when I go through these slides, I tend to always start off with what I'll try to say is a sort of quick summary of how I see it. And I'll probably describe it as, I think, resilient trading in H1. So you probably heard from Adam already that we're slightly down on revenue, which is just 3% half year on half year. That is very much to do with the VAR revenue, which Adam just mentioned. So in Q1, we obviously had effectively some market shock from COVID coming in, and I think quite understandably a lot of companies were withholding their capex spend in that period. So we saw that in Q1, and kind of like for like Q1 to Q1 was 200 to 300k down. So that's essentially what we've seen come through in the full half year revenue number. But really what else we have is profit and EPS growth, which we're really pleased to see, and a very, very strong net cash position. And those are really fundamental things for this company, and in terms of where we want to be and the growth forwards. So we'll see from the slide Adam had put up before and the one you've got in front of you, the EPS is growing, adjusted EPS is growing well. We expect that to continue to grow. Adjusted PBT similarly is on a growth trajectory. So despite this being an H1 COVID affected period, we're still able to demonstrate that growth. And in terms of net cash, I think that's been a really strong area of our business. I'll say a little bit more. We've got a slide on cash, and I'll talk more about that. But I think in terms of our performance in that area, particularly given the year we've had, I think is very good and highlights the fact that this business, and in fact the business model, is a generator of cash, which is obviously good to see. So this slide is on the H1 income statement. I'm sure many of you have seen this from our RNS already. So we've talked about revenue. Maybe I'll just jump to gross margin. So our business model generally looks at a 75-25 split of managed income, managed service income, and VAR. This half year we've managed 83% managed services and 17% VAR, value added resale. That's unusual, and it's back to that Q1 position where we had that lower VAR revenue result. So we do expect the revenue mix to return to, or more closer to normal, if you like, by the end of the year. And obviously Adam's just put some little caution on the catch up on VAR, but essentially we'd expect the full year to be around 78 to 80% managed services, 20 to 22% VAR. What that does, it clearly has a impact on the gross margin. So you'll see that FY20 we had a 57% gross margin. That is where we expect to be for the full year. Managed services typically runs at mid-60s% margin. VAR, which can typically be the equipment sales, is obviously a lower margin between 20 to 25%. So revenue mix will always have an impact, but we have pretty steady revenue mix, and we can forecast that fairly well. In terms of overheads, again, my summary of where we are on overheads, I think, is in a very good position. We've worked hard to get our overhead in this group to be the lean position where we need to be. And I say lean not only in so much as we've got the platform of overhead, we've got the right number of people in the business, we've got the right level of spend going through to now support the revenue, and in fact a bit more, and then to continue to invest going forward. This has come through some acquisition synergies, and acquisition synergies are typically, as you'd expect, in terms of people. You tend to find you grow the business and find that some people you don't need following the acquisition. So that's a good position that we've achieved this year. We've had a small impact, as you'll find every company has in the half year, from travel costs being down, as you'd expect. And there's a small impact again from the fact that we've done Project Fusion in half one, which has been a really good big thing for us, to get a unified set of systems together in this group, and we just capitalised some of our costs only at a low level though. But the driver for the overhead reduction, which you can see there, is synergies. Just reiterate the point that no employees have been furloughed. So again, sometimes you look at income statements and you're trying to figure out what are the odd things in there which you need to block out. Well, there's no furlough, no grant income, no one-off credits at all in that. So it's a nice clean income statement from that perspective. Exceptional items, just generally in terms of SYSGROUP, will typically be, as you'd imagine, professional fees when we make acquisitions, and it'll be costs of integration following acquisitions. You'll see this half year, it's very low at 36k. So that is predominantly for the closure of the Bristol office, which was a small office we had from a legacy acquisition, which we decided we didn't need anymore. We don't expect exceptional items to be popping up in any particular way in H2, so that's a good trail for the full year. Share-based payments have come up. Obviously, we'll have share option grants, which is a method of incentivising our team. We'll continue to do that. And in terms of profit before tax, it's good to see we've obviously turned the PBT in the half year, and again, we'd expect that to continue through to the full year results. So in terms of the statement of position or balance sheet, as probably most people recognise, it's a very straightforward balance sheet, and I think that's the first thing I'd say for people trying to look at our results, understand our results. It's pretty straightforward. It's simple. It's all about working capital. It's all about cash, and obviously when we make acquisitions, you'll find intangible assets, goodwill get affected. The biggest number change, and I'll just jump to it straight away, is you'll see contingent consideration of £1 million liability, which was there at the half year last year, and full year in March 20. That was the remaining earn-out contingent consideration due to the vendors of Certus, which we bought in Feb 19. We were very pleased because Certus was an excellent acquisition for us. They achieved the full earn-out potential. They hit their profit targets, and that amount was paid in H1. So that's been paid out in cash in H1. You'll see that in the cash flow. The other sort of key drivers of working capital, as you'll know, it's obviously things like cash collections from customers and how we pay our suppliers. I think just going back to how we felt back in April when at the start of COVID, I was certainly of the view, and I'm sure everyone else would have been, that cash collections would be made more problematic. We may suffer customer defaults on payment. What's been interesting and naturally pleasing for us to see is that our debtor days has stayed constant throughout the period. It's not what I expected, but I guess it's an element where you've got to look at what we provide, and what SYSGROUP provides is critical infrastructure as IT services into customers. So in terms of payments in, we'll always be judged pretty high up the queue to get paid. So that's been a really good position for us. One thing we did do back in April, I think we mentioned this in our June annual report, was that we had about 20 customers come to us very early on in the COVID difficulties asking for financial support. And we did, Adam and I did have a long conversation about that, and we both felt that we should do something to help other customers in terms of the community. So we looked at the customers who came to us, and there was about 5 that I kind of thought was trying it on, insofar as let's see what we can get away with. But there was actually 15 who we felt we got good relationships with, we should continue to support. So we extended payment terms for those customers, which they very much appreciated. And they've all come out the other side. They're all completed and finished. And we've actually got good, strong relationships with those customers, which is good to see. In terms of supply payments, we do a monthly payment run every month. We pay who needs to be paid, insofar as if it's due to be paid, we pay it. So there's nothing around picking and choosing suppliers. There's no cash stretch in the cash number at the end of a half year. It is what it is, and that's again a sort of measure of how we work here. We value our relationships with suppliers, obviously from how they deliver to us, but also in terms of how we deal with them. So no change in terms of how we're dealing, and continue to deal. The VAT payment Adam mentioned, that was precautionary, insofar as at the time we felt, well, if it's on offer, we may as well take it, because it was that early in the COVID arena where we weren't sure how it would turn out. But we intend to pay that likely January or February next year. Bank loan quarterly payments all paid, no deferrals whatsoever. We've got good headroom in our covenants. We meet them, and actually we have a very good relationship with our main banker, Santander, and then they continue to support us with loan facilities as well. So just into cash and net cash, this is a strong position for us, and hopefully you'll be able to see this from numbers on this slide. So at the end of FY20, so this was March 2020, you can see that we were 69k net debt in the bottom right hand corner. That's moved to a 1.2 million net cash position at the half year. And that's post, for those of you who do your accounting standards, that's post IFRS 16, where the property leases came onto the balance sheet, so post those liabilities. Excluding the property liabilities, we're at 1.6 million net cash, which is a very strong position. So how do we do this? Well, we have a very good cash conversion rate. We've traditionally said our target's 80 to 90%. We're starting to edge at the higher end of that, and as you'll see here, we've got a cash conversion of 115% in H1. That includes interest payments and tax payments. The cash conversion of 115 does include the tax, the VAT to 80k deferral, which is why we've shown the underlying. So if you remove that, the impact of the VAT, that's a 95% against 96% last year. So you can see it's a high cash conversion. The other point around this, of course, is that it tends to be a proven factor of quality of earnings. So what we've got is a high proof of our earnings are actually converted into cash, which is good to see. You can see the large number in the cash flow for half year is the 975k, which is the payment out for the Certus earn-out consideration. There's no contingent consideration left to go or deferred consideration left to go, so balance sheet has got nothing left to go. There's been no further bank drawdowns, equity raises in the periods you can see. The one other thing we have around us is we do have an unused 3.25 million acquisition revolving credit facility of Santander. That's ready and available to go if we find the right acquisition target. So combined with the cash we're generating and starting to put on our balance sheet and the acquisition RCF, we're in a pretty strong position to find suitable businesses and bring them into the SYS Group. So I think that summarised it for me, Adam, and back to you.
Thanks, Martin. Great update, thank you. So yeah, just to summarise before we move into a Q&A session on what we've just been through in the slide deck. Again, I'll reiterate, revenue's been extremely stable, 9.01 million for H1, given the macroeconomic climate in which we're trading and the impacts from COVID-19. So both myself and the business are pleased with that result. Again, adjusted EBITDA being up 19%, I think that's another fantastic outcome for us in this period. And turning that EBITDA into cash with 95% underlying operational cash conversion, I think that's a really key metric that investors will be watching in this kind of business. You know, I've seen plenty of other companies out there who've got lots of EBITDA but not the cash to back it up. I think that's really demonstrable of our business and how solid it actually is. The acquisitions that we've made, I'd make them again. They've been very, very successful for us. They've helped accelerate the journey to become the £100 million market cap business that we want to be. The Project Fusion program and the completion of phase 1, again, it's been another fantastic thing for us. In a short space of time, we've brought 3 businesses together. We've got them operating under a single pane of glass. We've got the visibility across the business. We can report on the customers. We can support the customers across multiple functions within the business, all on a unified platform, which again, it really, really helps us, and it will help us integrate future acquisitions with relative ease now that we've got that solid platform in place. And again, the final thing that I have to draw attention to is how the business has managed to prove itself as being so robust throughout the COVID-19 pandemic, and you know that's demonstrated through the revenue and the EBITDA delivery. We really are a relevant business. We are what is required by many businesses, and I think the opportunity moving forward into future periods, as businesses start to stabilize themselves and we get into potentially a vaccine situation, people are really going to start to have digital transformation and outsourced IT services as a standing agenda item on their board meetings. So, you know, SYS Group is a really, really relevant business, and I'm excited about what we've got to come. And that concludes the presentation. So I'll hand back over to Mark.
Thank you very much indeed, Adam, and thank you, Martin, also. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab. But just while the company take a few moments to review the investor questions that have been submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, will be made available via your Investor Meet Company dashboard. I'd also like to remind you that your feedback is important to the company. Immediately after the presentation has ended, you'll be redirected for the opportunity to provide feedback in order that the company can better understand your views and expectations. Now, that's about as long as I've got to give you to review some of these questions, Adam and Martin. But perhaps what I'll do is, if I start off with the first question, and if I could ask you to look at the Q&A tab, and I guess just read the questions out. Obviously, no one can see anyone else's questions, and give a response where it's appropriate to do so. The first question, just to make sure you're on the right page. Great presentation, thanks. What do you see as your greatest risk to executing on your strategy? And secondly, out of interest, what are you looking for in future acquisitions?
Yeah, okay, thanks, Mark. It's a very good question. What do we see in terms of risk? Obviously, there is risk in executing the strategy, given the fact we're a buy and build business. We face competition from other acquirers, other trade acquirers, and also that from PE as well. We continue to monitor and assess other deals that happen that we don't necessarily get involved in, and we look for trends there to make sure that we're relevant in terms of what we're trying to do. And we try to be very successful. And when we do find a business that we'd like to bring into the SYSGROUP portfolio, that we use all of our combined knowledge and efforts in order to attract the vendors to want to make a sale to SYSGROUP. And I suppose in terms of answering the question about what we're looking for in respect of future acquisitions, the answer to that is very, very simple. Now we are where we are in our journey, and a lot of the building blocks are in place. We're looking for more of the same. So it's all about adding scale to the business now and taking advantage of what we've already got in terms of the platforms and the robustness of the platforms that we can add to them and we can grow them. So we're not immediately looking to divest off into any other specific areas of industry. I mentioned early on in the slide deck, we've got a huge portfolio of services. We want to bolster that and add more of the same to it. So hopefully that answers your question. We've another question here. What were the main reasons for the low growth in managed services in H1, given the recurring income nature of contracts? Has SYS lost any contracts? Do you have the ability to put prices up, or is there downward pressure on pricing? I think there might be 4 questions in one there, so I'll do my very, very best to answer that. I might have to keep coming back to it. So we forecasted growth in our managed services business in our AOP in a pre-COVID world, when we put these things together, when we put these plans together. And I'm not afraid to say that the growth that we anticipated hasn't come through. But people are reluctant to sign long-term contracts at the moment. People are reluctant to commit their businesses into new spend. They might be more than happy to recommit to existing spend, but the market is cautious right now. However, I see that as a short-term problem and not a long-term problem. In respect of we lost any contracts, if you've read the RNS that we put out yesterday morning, you will see we've an ongoing strategy of exiting certain customer contracts. So it's very, very normal when you acquire a business, especially a smaller business to your own, that you will inherit what we call a tail of a base. So they tend to be smaller contracts. They contribute revenue. They're typically not profitable, and they take up a lot of time and resource within the business. But they were used to dealing with a much smaller business pre-acquisition. So we have exited certain contracts through choice, which does have an impact on revenue. We've made that known to the market in the past. We call it acquisition attrition, but it actually makes sense for us to exit out of those contracts and focus on our sweet spot, being the UK mid-market. In respect of, do we have the ability to increase our prices? Yes, we do. Do we increase our prices? Not necessarily. Given the impact of COVID and whatnot, is that the right thing to do at the moment? Probably not. We need to maintain solid customer relationships, and we need to help where we can and do our bit. Although if we suffer cost increases ourselves, then we have the ability to pass that on through to customers, and we would do. And I think the final question in that question was, is there a downward pressure on pricing? I'm not seeing that. So I think the answer to that is no. We have another question. Have we hired or lost any key personnel in the first half? So at the start of the pandemic, we implemented a global recruitment freeze across the business. And we very quickly adapted that policy to become strategic hires only. The intention of the recruitment freeze in its entirety was in case our revenue fell off a cliff. As I said earlier, nobody knew what was going to happen. But as we saw the cash collection remain solid and we didn't see a huge fall off in contracted income, we continued to hire within the business. So we have continued to invest in people, and no, we've lost no key personnel during the first half of the year. What else have we got here? Given the strong M&A resource on the board, can we expect further acquisitions in the near term? Would you consider a large transformational deal? So yeah, absolutely. We've got some great M&A resource on our board, and that's by design rather than by chance. We are a buy and build company, and that is part of our stated strategy. So absolutely, we'll be continuing to make acquisitions. As and when we're going to make those acquisitions, that's not information that I can share. And in respect of whether we'd make a large transformational deal, I think you've seen the business make a large transformational deal, which was the Certis Technology Group acquisition. So we're by no means frightened or intimidated by making large transformational deals, and be more than happy to if the right opportunity presented itself. However, it's all about the right opportunity presenting itself. You know, there's many businesses out there you'll see with track records of making acquisitions for making an acquisition's sake. That doesn't form part of our strategy. And you'll note that we've not made an acquisition now for 17 months. And that's because the right opportunities haven't presented themselves. We've seen plenty of companies, we've seen plenty of IMs, but they've not been the right deals for SYSGROUP or the shareholders. So we've chosen not to execute on those deals.
Adam, do you want me to take the next one? I can do it pretty quickly. So I think Neil will be,
yeah, fine.
Do you expect a further R&D tax credit in the second half? And if so, what sort of amount? You'll probably forgive me if I don't give you a guide on the amount, but the answer on the R&D tax credit in general is yes. We are applying for the tax credits. We did one in FY20. We'll certainly be doing one in FY21. And if there's any other areas where we can do that, we will be doing that. So in terms of, I suspect the question behind those words is essentially how efficient is the tax number, and it's as efficient as it can be, with us doing everything we can on tax in the right way.
Okay, brilliant. Thanks for that, Martin. I think we've got time for two more questions. We've got one in from Andy at Liberum. Hi, Andy. Post-COVID and the UK return, as the UK returns towards normal in H2 next year, how do you think client requirements will change, if at all, and how does that change your acquisition strategy? Are you now looking for anything different in the target? Well, that's a brilliant question, Andy. So in respect of client requirements, it's a difficult one to answer. Yes, I do expect them to change. I expect those that have been reluctant to invest in technology or see technology as a cost, or the ability for remote working as a cost rather than an investment, to change significantly. So as businesses can return to discretionary spending and investing back in IT, I think the IT sector has got their hopes pinned on people wanting to invest in things that they might not necessarily have invested in the past, or, you know, home working is going to become a thing of the future. It's definitely a thing of now, but I think it's going to remain that way. So, you know, one of the things that I say to people, great people in interviews will always ask the question, what's your home working policy? I think the question moving forward will be, what should come to the office policy? So businesses who want to attract great talent are going to have to enable their systems and their platforms to allow remote working. And that means putting more of the IT workload into the data center. And in respect of, will that change anything in our acquisition strategy? I don't think it will. We'll be looking for businesses that have got customers that are focused on IT loads in the data center. And we'll definitely be diligencing further in respect of the quality of the customer bases. You know, I don't think right now we'd go off and we'd make an acquisition of a business that was 60% in leisure and hospitality, given we've seen how easily that can be closed down by UK government. I think that would add too much exposure to the business. But we'll definitely be looking into the targets for the robust nature of their customer base. So hopefully that answers your question, Andy. And one final question. SYS has had a resilient performance. How have competitors fared? How has the competitive landscape changed in the year to date? So absolutely, we've been keeping an eye on the competition, especially our listed counterparts, and we've been watching their results come out. And we'd actually like to think we've done slightly better than a couple of them. Listen, our business is focused largely on recurring revenue. We're all about recurring income contracts. The VAR part of our business that I explained earlier is a supplement to the managed services business. We don't transact with customers on a one-off basis, i.e. a brand new customer that wants to buy 500 laptops and we put 20 points on it and we sell them. We typically only transact our VAR business with our managed services customers who need the technology to access the platforms in the data center. So I think what this period will really demonstrate is those businesses that claim to be true managed IT service providers and cloud hosting businesses, you know, it will start to uncover the real quality of their income moving forward. And hopefully SYS Group has demonstrated and will continue to demonstrate the quality income that we've got in our business from real recurring revenue from real managed IT services customers. And hopefully that's answered everybody's questions. Anything that we've not got to, we'll do our best to get back to you separately after this. But that brings us to the end of today's session, and hopefully everybody's enjoyed it. And thank you very much for logging on and listening to us.
That's brilliant. Thank you very much indeed. And as you quite rightly say, obviously any questions that come in post this point, obviously we'll make available to you, to Adam and to Martin. Well, thank you very much once again indeed for updating investors as part of your roadshow. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide feedback. If you access this meeting from our website, then the feedback page will appear. If you access it via the link sent you by email, you'll simply be asked to log in to submit your feedback, and would really encourage you to give your feedback to the company. On behalf of the management team at SYS Group, we'd like to thank you very much indeed for attending today's presentation. That now concludes today's session, and good afternoon to you all.